The weather may have cooled off a bit, but the stock market temperature is still pretty hot as we have a series of potentially important news releases scheduled for the coming week. Top down, watch out for the June round of UK economic sentiment surveys or purchasing managers indices or PMIs. We have manufacturing on Monday the 3rd, construction on Tuesday the 4th and services on Wednesday the 5th. Any score above 50 is generally good enough as that suggests future growth, while any score below could be bad news as that can warn of a slowdown or even recession. This chart shows the trend for each reading over the last 12 months. For May, the scores for manufacturing, construction and services were 56.7, 56 and 53.8 respectively, so frankly, all suggested the UK economy is doing pretty well. Also keep an eye out for the equivalent US numbers for manufacturing and non-manufacturing on the 3rd and 5th of July, as well as American jobs and wage growth numbers on Friday the 7th. All of those could help the US Federal Reserve decide its next move on interest rates. Meanwhile, bottom up, the key company trading statements, well, they could be as follows. A trading statement from FTSE 250 wholesaler and Tesco merger target Booker, interim results from online grocer Ocado, and a trading statement from FTSE 100 house builder Persimmon, all on Wednesday the 5th. There's also trading statements from Primark owner Associated British Foods and another house builder, Bovis, on Thursday the 6th. And finally, watch out for a trading statement from retailer Dunelm on Friday the 7th. It's also Independence Day in America on Tuesday the 4th of July, and for me, the stock most likely to create a few fireworks, in the coming week is grocery giant Sainsbury, which is due to publish its first quarter trading update on Wednesday the 5th of July. As we can see here, the shares had a pretty good run until recently, as analysts began to warm to Chief Executive Mike Coop's big strategic move of just over a year ago when Sainsbury's pounced to buy Argos owner Home Retail. Like-for-like sales growth at the core UK retail operation had also begun to improve and sales at Argos were rising. However, the shares have just begun to lose some ground of late, and I think that may be for three possible reasons. First, Sainsbury's fourth quarter numbers, well, they weren't great. Like-for-like sales growth at the UK grocery operation fell again by 0.6%, even if total retail sales rose fractionally. Second, Sainsbury's is still locked in this battle for market share and consumers' wallets, not just with Tesco, Morrisons and Asda, but the insurgent discounters Aldi and Lidl. At least figures from consultants Kantar World Panel did show that Sainsbury's sales had risen 1.8% year on year in the 12 weeks of the 21st of May, but that was still slower than Tesco and Morrisons, let alone Aldi and Lidl, whose combined sales rose by 19.2% year on year. And over the last 12 months, Sainsbury's also lost some market share. And then third, analysts have been worrying about inflation and how it's been outpacing wage increases, potentially crimping consumer spending power. Those three things all make the timing of this first quarter update particularly interesting, although Sainsbury's is going to make some changes to how it reports its numbers, which may muddy the waters a little bit. We are going to get a retail like-for-like sales growth figure. This was 0.1% year on year in the fourth quarter, as we can see here, and at least that was an improvement on the prior three periods. We'll also get total sales growth numbers for food, general merchandise and clothing, including Argos, plus a figure for the convenience and online operations. There'll be no separate disclosure for Sainsbury's and Argos as the integration continues, however. And there will also be guidance for the combined group. For what it's worth, for the full year, the analyst consensus estimate is looking for sales, £28.1 billion against 26.2 a year ago. Pre-tax profit of 557 million against 503 million. And a third straight dividend cut from 10.2 to 10 pence. So at least you could say that expectations are pretty low. Thank you for watching, and I look forward to seeing you next time.